welcome back to another episode on Real Talk. I'm Tiffany, our transaction coordinator. I'm here with Mark, who is our director of investments, and we'll be talking about different ways to finance properties. So Mark, I'm going to just jump right into the first question. Are there any benefits to financing properties at the beginning of the year versus now?
Well, I mean, I guess, by no means am I an expert in financial strategies. Consult your financial expert or something like that. But there's obviously different ways of looking at that. Whether you want to buy something at the end of the year because you're going to need a write-off, and the kind of investing. So, during our podcast here, we'll sit there and discuss the different kinds of financing. But the long way to answer that is you can always at the end of the year do this because there are tax advantages to that. But then at the beginning of the year as well, it's a good time to buy because you can have more expenses build up through the year. Right. So for example, like when you're talking about what are some of the benefits and things that you can write off on a rental property or a second home or something like that, you can deduct your mortgage interest. You can deduct operating expenses, the property depreciation itself, any ownership expenses. So if you're using a property management like we have with Independence Property Management, you can write that off. And of course, if there's any repairs. So if you're thinking about all those things like the interest and expenses, depreciation, IPM, like property management, and maybe some repairs on the house, if you did that at the beginning of the year, of course, then you would have 12 months of those, and so that would be a better write-off. Right. Versus say you're going to buy a house, in cash and you're rolling over like a 1031 exchange or something like that, then of course, it might make sense to do that at the end of the year, right? So, right. Yeah, so it's a loaded question. It is one of those ones where I guess depending on whatever situation you're in, talk to your financial advisor, talk to your CPA or the person that deals with your taxes, and come up with a strategy that's obviously best for your tax situation. Awesome. Long-winded, right?
That just depends on your goals, right?
That's exactly right. So who knows? Everybody's in different spot for that.
Right. So you mentioned tax benefits, which actually I think kind of leads us into the next question. So are there any tax strategies that you can use to finance a property?
Yeah, absolutely. So, I mean, again, make sure that you contact, I know enough to be dangerous, but, so what, like we had mentioned earlier, like a 1031 exchange. And so in essence, that's just deferring, your tax obligation. So it's, for when you buy a property and you make money on that property, taking what you've made on the sale of that and rolling it into another property, of course, would defer that tax payment for you. And so, it's popular, the 1031 exchanges. I mean, interest rates right now are so low, borrowing money. And I know that we'll probably get into this in a little bit later, the different kinds of financing that you could do, but borrowing money right now is so cheap. And so, right. I mean, there's different ways. And another one that we'll probably touch on in a little bit as well is the BUR method. And so, one of the things of that is putting your own money into, either the rehab of a turnkey property or putting some of your own money into upgrading or updating your rental property. Those are things that can definitely be a tax strategy because those are write-offs. Right. Now, again, I'm not an expert by any means, but some states, I know that here in Ohio, for your primary residence, any updates that you make to the house, that's just living expenses that you don't get to write that off on a primary. But if you or I owned other properties here in Ohio, any dollars that we do and improvements, those are definitely write-offs. So
awesome.
There's those tax benefits. And like I said, some of those other ones that we talked about really allow you to leverage, your tax liabilities at the end of the year.
Awesome. Yeah, you mentioned, that's funny because you said the BRRRR method, and that is the next one. Are you reading this list?
I'm reading your mind. You and I work so closely together that it's like,
Right.
you know, another day at the office.
Yeah, that was the next one. So, so the BRRRR method, how is this a smart financing decision? Tell us a little bit more about that.
Yeah, so the BUR method, you know, again, so that one is an acronym when you use all the letters.
Yeah.
So it's you know, you buy the property, get it rented, refinance the property, you know, pull that money back out, rinse and repeat.
Mhm.
So I think maybe what I got, or I missed one in there.
Rehab in there.
Yeah. So you buy it, rehab it, then you rent it, refinance it, rinse and repeat. So there you go. I missed an R. But like I said earlier, I mean, so with that, you may be able to buy a property that you're financing and then taking your own money to put back into it and writing that off, you know, the rehab of the property. And I mean, dollar for dollar, I mean, I'd imagine that comes right off the top of your 1040.
Yeah.
So again, check with your expert, but that's, to me, that would seem like a popular one if you had it, if you had the disposable money, you know, in order to offset some of your taxes. Why not put your own money in the rehab, or as much of it as you can? I mean, if you had 10 grand sitting around, you know what I mean, put that in it just to be able to write that off dollar for dollar. So in some of our other podcasts and vlogs, you know, I'm sure that we've described like our equity advantage series. In essence, that is the BRRRR method. You know, for our investors, we have properties that you can purchase before we start rehabbing them. Now, they go quick because, again, like in this market, you know, our construction guys, they're working and they're working and they're working. So as soon as like a crew is assigned to that, we as a company have contractually told them you're going to get paid to rehab this house. So if somebody's wondering like, well, why is it in this EAS for like a week? Well, because these guys are, you know, looking to pick up contracts and looking to get work. And so that's why they go so quickly. But, you know, going back to the equity advantage series, you know, it's a great way for you to buy a property, have it financed, pay for the rehab, maybe even our instant cash flow. Same thing. Buy a property that's currently renting.
Right.
Buy it, sit on it until somebody turns, and when they turn, take your money, do the rehab, write that off.
Yeah.
You know, increase your rent. So there's just so many different plays. And so, I mean, that's what's fun about real estate. That's what's fun about, like, you know, the turnkey market, is there's so many different avenues. You really have to do your homework as to like what would be best for you as the investor. So
yeah, so really figure out what you want, you know, and then let us help find what fits for you, right?
absolutely. So that's, you know, a lot of that comes like with those strategy session calls, you know, whether they're with me or they're with CJ. You know, a lot of people, you know, will talk to either of us, but a lot of that is fact finding. You know, what are you doing? What ultimately do you want? Like everybody's always like, I want passive income. Of course you do, but what do you really want? You know what I mean? What's the second goal behind the passive income?
Right. Yeah, and you mentioned, this isn't on my notes, but you mentioned how fast those go. I mean, they're hard to even hold, those equity advantage. So
yeah,
I know
exactly,
we're literally holding our contractors back at the door sometimes, you know, give us a couple more days.
Isn't it crazy? It's like, you know, we get an email saying, hey, we have this property available. And then by the time I send out like some emails or something, like, oh, that's gone.
Yeah, we've had contractors, I think, sitting in the driveway of properties we've closed, ready to, that's a whole nother, you know, thing, but.
Right, that's a whole other vlog.
But it's just funny, you know, it is hard to hold those, but knowing you want to do that, I think is cool, because I know you've been able to help people find properties that work for them.
Absolutely. I mean, these are, so, you know, here in our company, we can find those turnkey properties. Again, I'm a licensed real estate agent for the Cincinnati and Dayton MLS. So if our investors want me to just shop on the MLS, and find them a house that maybe doesn't need as much rehab.
Yeah.
So, I mean, again, it's endless possibilities.
Right. Awesome. All right, back to some different loans. So home equity, what is a home equity loan and the benefits to that?
So a home equity, so you'll hear this one, the acronym of the HELOC, home equity line of credit. In essence, that is you using your primary residence and pulling the equity out of that in order to use money. Now, different banks have different formulas or how much they'll lend. I know here in our area, typically a credit union or something like that will give you better than a big bank or something like that would. But what they're going to do is they're going to give you, 70, 80, 90%. I mean, I don't know. I've seen some, I guess, that'll give you 100% of your equity. So when you're trying to determine how much you have to take like, what is your home worth versus what do you owe? And then it's 80% of that difference. So let's just say that you have, a $250,000 house, you owe 150. So there's $100,000 of equity. You take 80% of that. So now you can take out an $80,000 HELOC.
Okay.
Now, in essence, what that is a second mortgage on your house. So you have your first mortgage, and then in your second position would be your HELOC. And typically those have great repayment structures. And that's why people use those, because you can pull out, let's just say for our example in that, you pull out that $80,000 and you can then use that $80,000 on purchases, and you'll only be paying the interest on it. And so now you can pay the principal down, but you, in essence, only pay the interest for so many years. So typically it's like, say, 15 years. So if I use all $80,000 on the purchase of a house or refinance, or I'm sorry, like flipping or whatever, I want to buy a new car. It doesn't matter. You can do the HELOC, whatever you want. But let's just say that I use that $80,000. Well, then I'm only paying the interest on that $80,000. So, sometimes people use a HELOC to buy a car because it's cheaper than going to the car dealership. Yeah. But for our purposes, when you're talking about turnkey and you're talking about, maybe paying for a rehab or buying the house itself, once you refinance that money out, or say you put the money in to get the rehab and improve the value of the house, and you pull that money out, well, then you just pay the HELOC off again. And again, when you set up these HELOCs, and check with your bank, because again, they all have different structures. So I don't want to point one or another, but for example, let's just say the same HELOC, you're paying down the interest of it for 15 years or whatever, but it also means that it could be open for 15 years. So it's like having a $80,000 credit card. You make purchases, you pay off the credit card, the money goes right back, and you can just keep using it. So, so that, it's a powerful tool if you have equity in your primary residence where you can do that. I'm sure there's banks out there that'll do HELOCs on rental properties or what have you. So as you build the equity and you start paying off your mortgages on these rental properties, you really put yourself in a power position. I think those first like couple that you buy, 1, 2, or 3 houses or rental properties, that just kind of gets you going. But once you get where you have a portfolio loan, and again, I'm sure you know more about that than I do. You do portfolio loans, God, you have some real buying power. Right. So whether it's HELOCs or what have you, just equity that you pull out, cash out equity. Just so many possibilities. It's just it's crazy. So
I've seen.
Get started, right?
Yeah, I know we've done some HELOCs, some closings just this year. I think we did a couple of them. So
I was gonna say, as the transaction coordinator, you probably see way more how it gets financed versus for myself,
Yeah. I might see those things come across my desk. I don't always understand them, so I'm learning a little bit right now.
Oh, okay, right. Yeah.
Maybe I didn't know.
Like I said, just enough to be dangerous.
Yeah. Awesome. So how does, so I mean, you kind of answered how that differs from a conventional loan, but
Sure.
what would be the advantage of getting just a conventional loan on that, or disadvantages or anything different?
Yeah, I mean, so again, obviously you'd have to check with your bank to see. I mean, sometimes those conventional loans, we talked about it earlier, the money right now is in essence free. I know that, when I'm talking to some of our lenders that we work with here, whatever the rates are that you see, they're always going to be a little bit higher on
Right.
your rental property. So, I mean, if you see that rates are out there at 3.25,
Mhm.
assume that you're going to pay like 4.25,
Right.
because again, it's a little riskier of an investment. But sometimes it's good to obviously shop your rates, but yeah, a conventional loan, of course, is the gold standard. You're 20% down. I've heard some of our clients even say that their banks they work with 25% down,
Okay.
especially when you start getting into multiple doors, like a duplex or 4 unit,
Right.
those conventional. So with those, of course, there's going to be a little bit more lending guidelines and rules and stuff like that. And so always check with your bank and ask them some questions. You know what I mean? Like, how quickly do you close these? Because again, at the end of the day, the goal is to close on the property as quickly as you can so you can start cash flowing. If they're a 60-day, 90-day close, like, do you really want to wait
Yeah.
3 months to start generating income, or do you want
Right.
30 days and start doing it? So I know that, like, for us, when we're talking to our clients, we always want to know, what kind of lending are you doing? And
Yeah.
it's not because we're trying to pry, we're trying to help you,
Yeah.
get there quicker. So,
Right.
but yeah, conventional loan, like I said, that's like the gold standard. I'd say probably what 75% of what we see is that.
Yeah. Yeah. Honestly, it's a lot. It's conventional. Like I said, we had a couple HELOCs, and we have some cash purchases as well, but I would say most of what we're closing is conventional, right?
Yeah, absolutely, absolutely. And so, I mean, even that, and even taking that a step further. So when we're talking about some of the different kind of lending things as well, is that there are some banks that will actually loan on rehabs. You know what I mean? So you might, um, again, let's just say it's $100,000 property, right?
Right.
They may give you 80% loan to value on that. So they'll give you $80,000 towards that $100,000 property, and you're putting down your 20%. But
Mhm.
then let's just say that there's 30 grand of rehab to make it a 150 property. They may give you that $30,000. So
Okay.
there are different lending programs and banks that just have all sorts of kind of, I mean, literally, it just takes some time for the investors to find that. But
Yeah.
there are banks out there that will lend, you know, on a rehab too. So you don't necessarily, like when we were talking about, having to have all this money for a rehab. You don't have to. There are banks
Yeah.
out there that will pay for that. And so we'll pay 100% in the rehab. So there's definitely
Awesome.
that.
Awesome. Um, and you can also, so we have on here, you can also use like a private money lender, right? How would that, how would that work out?
Yeah. So, I mean, I know that you are going to be more the expert here in the private money lending
Yeah.
because, you and CJ and a couple other, folks in the office deal more with private money lending. But from what I understand, private money lending is another investor
Mhm.
loaning you the money to do this, and
Yeah.
then them taking back a set percentage of this when it closes.
Yeah.
So I think you'll hear these also be called a hard money loan,
Mhm.
or something like that. I mean, the rates could be 8%, 10%, 12%. Sometimes they have different things like that they want, like if you're late, on the close, that
Right.
they want some sort of points or, juice on top of the loan. But
Yeah.
they're definitely the riskiest.
Yeah.
But, there are investors out there that to them it's a safe investment because they're investing on this property. And if
Mhm.
you don't live up to the terms of it, well, they own your property.
Yeah. That's true.
right? So,
Yeah. They got a property out of it,
yeah, so it's not really too risky for them, but it is definitely risky for the event, for the person that wants to take the hard money loan.
Yeah. Yeah. And I know we work with private money lenders
Sure.
every day. I enjoy that space that we're in. I know we have actually had an investor. I remember at least one that we've had who used a private money lender. I think the benefit of that is for their timeline, that's as good as cash.
Yeah.
We don't have to wait for your private money lender to underwrite it. You don't have to wait for them to ask you for this. Underwriting sometimes can go on for a while, right? So it does kind of cut through some of that stuff. You can still get an appraisal if you want to. It's in my mind, it's as good as cash, when we do that. So when we use them. So sure for our investors, it would be the same thing. Maybe a little bit harder to find somebody who would do that, but
Right. Because when you're doing, correct me if I'm wrong here. So when you're doing a private money loan, you are presenting to the investors at least like a broker's opinion price of the property, right? Like an after renovation value, like here are some of the comparables that we use because this is what we feel in our professional opinion that it'll be worth, correct?
Yeah, absolutely. Yeah, I give them, typically you've probably approved the price, you and somebody else on our team. I know it goes through a few eyes before it gets to me. So we've got, kind of here's what we think it'll sell for after value. And then here's what we actually just want the loan amount for. It's never the full after rehab value, but yeah.
Yeah, no, absolutely. And I mean, so that brings me to, the cash, so, when you're talking about financing, cash is king.
Mm-hmm.
The reality is that it is, because again, it ultimately gets you to close on a property sooner.
Yeah.
Because you do not have to wait for the appraisal. I know that sometimes when you're talking to investors, they don't understand why a property is ready to be bought in cash versus, it's finance ready. And the simple answer for that is finance ready means that it's ready for an appraisal.
Yeah.
A cash buyer can buy the property on the promise of it being rehabbed.
Yes. Yeah.
What I mean? And again, as a company, and we've been doing this for a long time, yeah, what I mean? We're going to finish the rehab. You still can do inspections. You can still do all the things except for an appraisal.
Yeah. Yeah.
I mean? You're buying that, taking our word for it, and we're pretty good, I would think on our appraisals. Nobody's perfect.
You could do an appraisal, right? You could do like a hypothetical.
Yeah.
If you're not using a lender, it doesn't, because that's really the point of not getting an appraisal for financing, not doing it early. They're going to come in and say, well, it's subject to all of these things. Well, maybe we were going to do all those things, but that just gets us in this whole mess. We're probably going to do all of that.
Right.
But you're going to come back in and have to inspect every single, it's just, that could get into a mess. So of course we're not going to do that. We're going to wait till it's good and ready for you.
Correct. Especially because appraisers right now, I mean, they weeks
Yeah.
weeks out to get an appraiser in. And then, so if you have a subject to list, by the time you do those things and then get them to come out again.
Yes.
I mean, you're talking about delaying the process. So you're 100% right that like the reason we hold off to say when something's finance ready is because it's ready.
Yes.
I mean, rehab's done. We're very close to a punch list.
Yeah. Yeah.
We're not dealing with that subject to list, but
yeah.
I mean, so again, like with those cash closings, it doesn't mean that if you close on one in cash, wait 6 months, 3 months, whatever the seasoning period is, or whatever you want to wait, refinance it, pull your cash back out and apply it to another purchase. So again, it's once you get into those different positions and you've talked to a tax professional or a financial planner, map it out. map it out, like, see yourself. Don't just talk about what you're doing this year. I mean, 2022, in my opinion, should already be planned. You should be talking about what you're going to do in 2023. How much money are you going to pull out of each property? What are you going to do with that? What tax offset is that going to do? So they have all these things ready to go. You should be thinking 2023 already.
For sure.
But yeah, that's the short and dirty of financing, right?
Yeah. And you covered the last question, which was cash. I mean, that kind of all rolled in together with private money. So, it kind of rolled seamlessly into the next question of cash.
Yeah, exactly. So, so hopefully after everybody's done watching this podcast here, is that a little bit about the different kinds of financing, the different kinds of tax benefits that you may or may not have. But I mean, ultimately, I guess if you were to have some takeaways, is that there's many different options to finance properties. There's not one more correct than the other. It's just what's most correct for you.
Right.
That time of year, what makes the best, advantage to you and your family and your investments. But I mean, those should be the takeaways from after watching this is, start planning.
Yeah.
Have a plan, stick to it.
And get creative, right? A little bit.
Absolutely.
I mean, I've heard you go on, you'll go on a call with me and you're like, hey, what if we do this and this, and we help them do this? And
yeah, right.
It's always over my head, but I know you've got creative ideas, so I'm sure other people do. So, get creative and figure out what works for you.
Right. Most of the time it's like so creative. The bank's like, you can't do that. What are you talking about?
I'm like, Mark, what are you talking about? Listen, if you want to do it, do it.
Right? No, that's awesome. That's awesome. So.
Awesome. Well, anything else that you had?
I think we nailed it. I think that should be a good little piece for people.
Awesome. Well, do we end this?
We always like to sign off, right?
Yeah.
Invest smart
and live happy.
We'll see you next time. Thanks.
Nothing on this show should be considered specific personal or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions and information on this show are not guaranteed. All investment strategies have the potential for profit or loss.